The Federal Reserve has crashed the car market. Well, sort of. Just this week, the Federal Reserve announced that they would be raising interest rates by 25 basis points, which means that if you're somebody who's interested in borrowing money in order to buy things like a car or a house, well, borrowing that money just got even more expensive. This is, of course, on the cusp of bank failures and concerns that more bank failures could be coming soon. So this interest rate hike did come as a surprise to some because there was some speculation that possibly the failure of Silicon Valley Bank would cause the Federal Reserve to second guess any additional interest rate hikes for the rest of the year. But obviously that wasn't the case, and the Fed did raise them once again. So in this video, I'm going to be breaking down what all of this means in the context of the used and new car market, and of course what it means if you're somebody who's interested in buying a used or new car. So let's get started. Jerome Powell, the chair of the Federal Reserve, spoke the other day, and he gave us not only news regarding interest rate hikes, but also gave us insight into what the future of the economy could hold for the rest of 2023. And I think that this outlook could have a pretty significant impact to the car market as a whole. So first are the interest rate hikes on their own. Interest rates are already very high, and as we sit here today, auto loans are at a 12-year high. And while the 25 basis point increase that we saw this week certainly doesn't help the situation, it doesn't really make the situation infinitely worse either. Because while interest rates absolutely do affect the affordability of things that we want to buy or finance, it has much more of an impact on something like a mortgage than it does an auto loan. And while of course the rising interest rates have made car loans less and less affordable, the 25 basis point increase that we saw this week alone isn't going to have a massive impact. Auto loans are already unaffordable, and this doesn't really change that. But interest rates aside, there are some other key takeaways from this meeting that I think will have a much larger impact to the overall car market. First is inflation. During the Fed meeting, there was a huge emphasis on bringing down inflation to 2% at all costs. And the reason why this is important to the context of the car market is because the car market is actually a large contributing factor to inflation as a whole. Used car prices are one of the largest components of the Consumer Price Index, and CPI is an indicator of inflation. The used car market makes up 4.5% of CPI, and for every percentage that used car prices increase, this impacts the overall inflation rate by 5 basis points. Inflation is a huge concern for us as individuals, the federal government, and the Federal Reserve. And if we're going to bring inflation down to that 2% mark, well, it can't be done without also bringing down the car prices. If inflation is going to go down, car prices have to come down with it. So this is of course great news because as the Federal Reserve is making moves in order to bring down inflation, this is hopefully going to have a trickle-down effect to the car market, bringing down car prices as a whole. Next up is the banking issue that has been caused by the failure of Silicon Valley Bank and others. Banks are raising flags and concerns about their ability to weather a financial storm or a bank run, which is what we saw with SVB, where a bunch of people wanted to take all of their money out at once, and the bank simply didn't have those funds. This is a concern for banks, but especially smaller ones. These concerns are in turn going to cause banks to choke credit. This means that banks are going to be more strict and stringent on who they loan money out to. This is because banks need to remain liquid, and whenever a bank loans money out to somebody for something like a car or a home purchase, this takes money out of the bank's pocket and gives them less cash to work with. So in order to make sure that banks have a nice cash cushion in case something does happen, they're going to be less likely to loan money out to certain candidates. So currently in 2023, not only are we facing higher loan prices because of an increased interest rate, but there's also going to be an issue with people getting qualified for loans at all because banks are simply going to be more selective as to who they loan money out to. This is absolutely going to have an impact on the car market because it's going to decrease demand. We are not only experiencing people that can't justify a car purchase because it's simply too expensive to borrow money for a car, but you're going to potentially have an entirely different segment of buyers who would look at financing a vehicle, but they simply can't get approved for one. This is going to lead to less people being approved for auto loans, which will in turn decrease demand, which will cause prices to go down, which is good news. The next topic that was discussed was unemployment. And this is, of course, a hot button topic that a lot of people are talking about. Amazon recently announced a large set of layoffs, so did Facebook, and layoffs are plaguing the entire tech industry, which is, of course, having an impact on the overall economy. As of now, unemployment is at 3.6%, which historically speaking is actually very, very low. But Jerome Powell did say that he expects for unemployment to rise to around 4.5% by the end of the year. The last time we had a 4.5% unemployment rate was in 2017, where the rate was dropping continuously and actually continued to drop until the pandemic, when the rates went through the roof to nearly 15% unemployment rate. A 4.5% unemployment rate isn't a particularly bad rate, but it obviously isn't as good as where we've been in the last couple of years. And of course, this matters in the context of the car market, because as people get laid off from their jobs, they are no doubt going to postpone or potentially cancel their new or used car purchase altogether, which will in turn cause less and less demand in the car market, which will cause prices to fall even further. This is all playing into the supply and demand aspect of the equation, and it's going to have a huge impact. This is of course going to be good news for the overall car market, car prices, and great news for somebody who may be looking to buy a car towards the end of the year. And of course, all of this leads to the topic of the R word, recession. Now, I know that the topic of a recession is a hotly debated one, and this is because there's a lot of belief that we've been in a recession for a while, that we will continue to be in one. There's others that believe we haven't been in one, but one is coming very soon. And there are even people that believe that we may avoid a recession altogether. This is obviously something that there isn't a right or wrong answer to, but it was something that was addressed during this Fed meeting. Now, to be fair, Jerome Powell did not say that we are 100% going to enter a recession, but he also implied that the chances of us entering one have become much more likely. Over the last year, as interest rates have risen, there have been discussions of a soft landing, which basically means, can we get out of this hole without entering a recession? In past meetings, the Federal Reserve has been pretty bullish that a soft landing could in fact happen. But in the words of Jerome Powell himself just a couple of days ago, he stated that a soft landing has become significantly less likely, indicating that a recession could in fact be in the cards. Now, obviously, a recession is never a good thing, but one could argue that we are due for a reset, and that reset could come in the form of a recession, which short term would not be so great, but long term could have big impacts in making large purchases like a house or a car more affordable. Now, as of right now, there are a lot of things that could happen in the next few months. The Federal Reserve has stated that they are going to raise rates one more time, but then will keep rates flat for the rest of the year. But there are other economic experts that believe that there's actually a chance that the Federal Reserve could raise rates one more time and then decrease rates for the rest of the year. It's honestly hard to say, and I am nowhere near smart enough to predict it. But what this does mean is that the economic outlook as a whole looks significantly more bleak than it did a year ago or even 6 months ago. In fact, the difference is almost day and night. The fact is, these banking failures have showed a real weakness in our financial infrastructure, and as myself and others have predicted, I don't think SVB will be the last weakness to poke its ugly head. I've said it before and I'll say it again, the car market will continue to go down. Every single indicator is pointing to this being true. So if you're someone who wants to buy a car and you can wait, hold off on that purchase because things are changing, and I'm willing to bet that when we look at the car prices this time next year, or even towards the middle or end of this year, things will look much, much different. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I'll see you guys in the next video.